It's the special edition of Business Incorporated. Thank you for joining us. I'm Chimezie Obi Iwagu. The Monetary Policy Committee of the Central Bank of Nigeria is set to announce its decision for the third MPC meeting in the year 2020 amid fears of escalating tensions arising from the spread of COVID-19. In line with a global trend where several systemic central banks have been announcing various stimulus packages to whittle down the debilitating effect of the virus. The CBN also had announced stimulus packages to support vulnerable sectors and stabilize the various macroeconomic frailty that are crystallizing off the back of the COVID-19 pandemic. And most central banks across the globe made aggressive interest rate cuts to buffer their economies against the effect of the coronavirus pandemic. Some central bankers in sub-Saharan African economies also followed a more measured approach when they sat down for their deliberations in the past 2 weeks. Now let's look at what some of them did. The South African Reserve Bank slashed repo rates by 50 basis points to 3.75%, a level not seen since the 70s. Ghana's central bank left its rate steady at 14.50% after cutting the policy rate by 150 basis points in March, but purchased the government's COVID-19 relief bond with a face value of 5.5 million cedi at the monetary policy rate with 10-year tenure and a 2-year moratorium of principal and interest. Zambia's central bank cut its policy rate for the first time in more than 2 years by 225 basis points to 9.25%. Kenya's central bank left its benchmark lending rate at 7% on Wednesday, as expected, after cutting the rate by a total of 125 basis points over 2 meetings to support the economy since its first case of the new coronavirus was reported in mid-March. And in about half an hour from now, the Central Bank Governor Godwin Emefiele will be announcing the key decisions at the MPC meeting today. Most analysts believe the Central Bank will continue to hold the key rate as it grapples with a marked slowdown due to the pandemic and the slump in the price of oil, the nation's top export. But then, what are these key macroeconomic indicators the MPC will have to consider as it makes its decisions? And what are the monetary policy responses so far to curb the effect of COVID-19? Temple Ashaju will give us those details. Temple.
Yes, Chimezie, thank you for switching over to this angle here. A lot of these macroeconomic policies are the key points that the MPC, the CBN MPC, will be considering. The macroeconomic variables that we know generally include the inflation numbers. You know that these actually came in last week, and of course it came in at 12.34%. That's from the National Bureau of Statistics. External reserves has recently been rising thanks to the inflows that we got from the International Monetary Fund, some $3.4 billion. And of course, the fact that crude oil has now increased by some percentage points, hovering around $35 to $36 per barrel. That gave us some room to be able to get in some FX inflows and has been added to the external reserves, giving us this particular number. This is the latest that we have on the website of the Central Bank of Nigeria. The GDP number, which came in on Monday, gave us a 1.87% rise, even though that is a bit of a decline from the 2.55% that we had done in the first quarter of the year. And of course, you know that on Tuesday we came in with capital importation numbers, which was also quite positive, a little above $5 billion. Now, exchange rates, what we have at this point, that's for the I&E window, the investors and exporters windows, which is domiciled at the FMDQ Securities Exchange. We know that it's been hovering around 386 naira per dollar, and of course, at some points, $389. But if you look at the futures and forwards market of this particular exchange, we've seen the naira being seriously under pressure. At a point in time, it crossed 500 naira, and that actually sent a lot of investors, into panic. But we know that there's also been an adjustment, and recently, because again, the adjustment was actually what brought us to 386 naira per dollar. Look at Brent crude; it's been hovering around $35, $36 per barrel. Even though today we know that there's been a bit of a decline in the price. Brent crude is the particular commodity that the Nigerian crude oil actually tracks. That will be the Kwaibo and a couple of others that we produce here. These are details of the last MPC meeting, which held on the 23rd and 24th of March this year. But before this particular meeting, we had the first one in January, 23rd and 24th of January. That was when we know that the central bank MPC actually expanded or increased the CRR, the cash reserve ratio, from 22.5% to 27.5%. Now, they left all other metrics actually unchanged. All other parameters remained unchanged. Before then, it had actually reduced the MPR to 13.5%. Now, we have at the last meeting 13.5%. That's what it remained as in terms of the MPR. Chimezie reeled out the numbers from Zambia and a couple of other countries earlier where they actually reduced rates. We didn't reduce rates, but we left things unchanged at 13.5%, even though there's been this argument lately that the MPR may no longer be a determinant factor for rates, interest rates, or lending rates in the market lately, because again, the central bank has been involved in a lot of programs, a lot of schemes, a lot of intervention programs pegged at 9%, and of course, a lot of companies, as the CBN had recommended, some 3 to 4 meetings. Commercial papers are now what some companies are leveraging at the FMDQ exchange. Look at the CRR, remained at 27.5%. At this period, we also know that there was so much of debits, CRR debits in the system. For those that failed to meet their CRR requirements, statutory requirements, there was a debit, even though there was some kind of refunds to a couple of banks that they later realized actually was able to meet the threshold of 27.5%. NDIC also, in the first quarter of this year, took its statutory premium from a lot of these banks, and that's affected the liquidity level of these banks at some point. Asymmetric corridor from the last meeting was left as plus 200 minus 500 basis points, nothing changed. And of course, liquidity ratio remains at 30%. Moving on to some of the economic stimulus that the central bank introduced, 1-year moratorium for a lot of the interventions. Of course, they also reduced rates from 9% to 5%. They got IOCs, international oil companies, and of course, servicing oil companies. All of them began to send in their inflows in terms of FX now to the central bank, as opposed to the tradition of sending them to the NNPC. Of course, we also know that there was an introduction of a 50 billion naira credit target credit facility, which some companies have been able to benefit from. Healthcare sector, 100 billion naira intervention fund. Of course, on one of our sister shows, we were able to bring in some folks who explained what has been happening, and we do believe that some of these companies have been benefiting. 10 local pharmaceutical companies were funded to fight COVID-19. 4 of those companies, Named, Fitsin, and a couple of others, are listed on the stock exchange. If you look at what they've been doing, their performance has changed since this COVID-19 inception. And of course, others are non-listed, but they've been doing quite well. Of course, there were a couple of other fiscal measures as well, taxes, and of course, moratorium across all other government intervention funds that are available directly from some of the financial institutions, DFIs, as we know.
Thank you very much, Temple. Well, joining me now to x-ray some of these developments you reeled out and, of course, give us an outlook is the Chief Consultant at B. Adedipe Associates, Dr. Biodu Adedipe. He joins us via Skype. Good afternoon, Dr. Adedipe. Thank you very much for joining us.
Very good afternoon, and I thank you for having me.
Now, aside from the COVID-19 outbreak, macroeconomic data indicates that Nigeria is heading towards recession. However, the first quarter GDP showed slowed growth at 1.87%. Inflation has been on the rise, currently at 12.34%. External reserves have been dwindling. All prices have slumped. The PMI is declining. What do you think would be the key consideration for the committee members at this meeting, and how would that influence their decisions today?
Thank you so very much. The first thing I believe the committee will be considering is we are looking at 2 major crises, and on the back of which there are 2 others, and that is the health crisis and economic crisis. And right on the back of those 2 are humanitarian and security crisis. So now the focus, in my own estimation, will not be on the traditional typical indices, but primarily survival, and then to bring the economy to recovery and growth subsequently. So in which case, what I expect that the committee will give attention to is how to reignite economic activities and also re-energize economic agents, which means at a time like this, what is most critical will be liquidity. That means putting more funds on the books of the banks to start with as financial institutions, and that comes by way of what you describe in banking as quantitative easing. Then the second line I think they will be giving attention to is how to get more funds in the hand of consumers. And that is in recognition of the fact that about an estimated 73% of consumer spending in Nigeria is about consumer items. So which means, how do we get those consumers to continue spending? But that will raise another challenge, spending on what? So which means, what we spend on becomes very critical at a time like this. So for that to also happen, it means whatever the committee will look at is how do we shape the policies and the signals that will enable the real sector be the beneficiary of this targeted quantitative easing. In which case, how do we boost the bank's liquidity, that is their liability book, in such a way that they can also support local production in the same way that the Bank of Japan has done. Now, that is the Central Bank of Japan. What that bank has done was to put a sum of $230 billion equivalent to the real sector in Japan and say, look, this is a time for us to look inwards. So I believe that this is something that the committee should also give attention to. And now, most importantly, is to talk about seeking a connection between the 73% consumer spending and domestic manufacturing, which of course will have implications for job creation and along the line also will impact inflation. That is what I expect we will give attention to today.
Yeah. All right, you talked about igniting the economy at this time. Well, the central bank over the period of this COVID-19 has tried to support small businesses and, of course, the pharmaceuticals with some kind of moratorium and, of course, reducing the interest rate. Do you see this also as a good measure to ignite the economy as you want it to be?
In fact, I will say that we need to give credit to the Central Bank of Nigeria, because if you do an aggregation of the various intervention funds and fiscal stimulus and other concessions variously across the spectrum, we'll be looking at a total of about 3.86% of our GDP nominal as at the end of 2019. So now if you look at that, it means the bulk of what goes into that 3.86% that we estimated actually came from the Central Bank of Nigeria. That's the right direction, quite all right. And not only that, also these interventions are targeted at important sectors of agriculture to start with, and for two reasons in any case. First is that agriculture remains the dominant contributor to our gross domestic product. Even the latest data of GDP shows agriculture still above 20%, about 21% of our GDP in terms of contribution. Now, that makes a whole lot of sense in terms of economic management. But the other side to it is, in responding to the economic crisis, the agri again, because it's all about food primarily, also comes as a priority sector. So the central bank has done well, giving a lot more attention in its interventions to that particular sector and the various food value chains. Now, the other side is dealing with the health crisis. And of course, as was just read out by Temple, and clearly the central bank also has intervened in the healthcare issues, either in terms of producing locally what can serve for us to deal with COVID-19. So they have gone in the right direction. Of course, the latest is what they put out only yesterday, and that is to also intervene with other financial institutions, which is all very good. But what we are advocating here is that there's a whole lot more that the central bank can still do. And the reality, like we had the New York State governor in the US say a couple of weeks back, that look, if the states don't have the funds and they now look up to the federal government in the US, and federal government says we don't have the money, say, look, you have the authority as the number one entity in the nation. Call the Federal Reserve to bring more money. Okay? So the thing really is that at the end of the day, everything will still fall back on the central bank as the banker to the federal government. So they can still review what has been done and look at areas where there can be more intervention Perhaps again give attention to the indicators with respect to MSMEs. Yes, they've done quite some work there, but you consider MSMEs usually dominate the bottom of the pyramid, either in terms of employment or in terms of consumption. So we can look at those areas, but also in particular try to tie whatever they give today to banks as enhanced liquidity by tinkering with liquidity requirements and also connect that to the real sector.
All right, Dr. Adedipe. Well, some believe that the central bank has exhausted all its capacities to support the economy and that monetary policy doesn't matter anymore in the case of Nigeria. Well, we will take a quick break and we will come back to you to respond to this. Welcome back. You're still watching Business Incorporated Special Edition, and I still have with me Dr. Biodun Adedipe, Chief Consultant at B. Adedipe Associates. Well, Dr. Adedipe, just before we went on break, I was talking about some belief by some people that the central bank has exhausted all its capacity to support the economy and that monetary policy doesn't matter anymore in the case of Nigeria. Do you agree with that? Because you are talking about the central bank having to do more.
Well, I don't agree with that assertion, and simply based on the facts of the way monetary policy works. I will take one plank first, and that is the relationship between the interest rate and inflation rate. Inflation rate in Nigeria is still below 13%, all right? And of course, MPR today is still 13.5%. Now, the gap between those two rates shows what we normally consider as an incentive to investors. So in which case, if I invest in any financial instrument and the return on it is indexed to the MPR, it means the closer the inflation rate to that particular rate, the less the return I have on my investment in real terms. So even if we drop the MPR to 13.3, 13.25%, there is still a space. So the issue for us is there any likelihood that inflation rate might top 13.5% in the month of May or even going into the near future? And in my own estimation, I don't see it going that high. And the reason is very simple. We reopened the economy at the beginning of May, and that means the pressure that was on price when we were locked down has eased somewhat. And we see that also flow into the inflation data. Of course, that is in the realm of projection. Now, the other side to it is the reserve requirements. So when people argue that, look, there's no wiggle space for the central bank, I will say that simply, just before we started this conversation, I received, a message that the Federal Reserve in the US is under tremendous pressure to reduce their own monetary rate. And of course, if they do that from where they are, they might likely slip into a negative interest rate. We are still at 13.5%. We are not anywhere near zero, even though we cannot compare the two economies or the monetary systems. But the reality is that CBN still has opportunity to deal with reserve requirements of cash reserve requirements, liquidity ratio of the banks, and even the MPR. So for me, they still have a lot of room, even within the context of monetary policy, let alone development targeted interventions.
All right, now let's look at the currency market. The Naira has depreciated, trading at above 450 Naira to the dollar, the parallel market. The CBN, in response to the oil price shock, adjusted the Naira. However, the argument by many is, why continue to defend the Naira, thereby depleting the reserve? And why can there be a unified exchange rate anyway?
Well, thank you very much for that. It's an issue that is a burning one in my own mind, and this is my perspective to it. It's only in Nigeria I see citizens excited to see their domestic currency lose value, instead of discussing on how to protect the value of that currency. Now, there are two primary responsibilities of the CBN with respect to currency. One is to maintain the real value of the currency, that is what it can command in terms of when taken to the market. The second side to it is the exchange value of that currency. So now, if I were the CBN governor, my concern would be to protect the value from those two perspectives. And that is why central banks do what we call inflation targeting, which means they always want to ensure that inflation doesn't go beyond a certain threshold that they have adopted to pursue. Of course, we know in the light of COVID-19, in some other countries around the world, they've thrown inflation targeting out of the window. Okay? So now the reality today is that we worry more about the exchange value of the naira, that is our analysts, because we think only of the finance side of the economy. There are two sides to every economy. There's the production side and then the finance side. Now, the production side means what do you produce and what do you sell? You sell internally, you sell to the rest of the world. So you command value by what you produce. Now, the other side is if you can't produce enough to sell to the rest of the world, and you appear to be buying more from them than you sell to them, it means finance has to step in, either in terms of borrowing or in terms of making the environment conducive for investors foreign to bring in their money here. So the real issue then is talking about capital flows. There are flows inwards and outwards. Like Temple said earlier on, if you look at the first quarter data for this year on capital importation, we had inflows that were about 54% greater than what we had in the fourth quarter of 2019. But of course, if you compare that with the first quarter of 2019, you will see a dampening of about 31%. But the real issue is this. First quarter 2019 was not anywhere comparable to first quarter 2020. So it is still good news for Nigeria, okay, somewhat. But the other side I want us also to look at is the fact that people say we defend the naira. I don't see that as that. Central bank is not defending the naira, so to say, as they interpret it. Central bank is trying to establish what is important. The moment we begin to produce what we consume, and that is the problem of our economy that floats on to finance, that makes us talk about the exchange value of the naira. If we consume what we produce, and we produce what we consume, then we move away from being a net importer of non-air goods, which has been the major problem of our economy since the early 1980s. I mean, for those who will recollect this, the 1982 Stabilization Act in Nigeria was a response to the massive importation that was greater than what we are getting from the export of crude oil. The same thing we've been talking about all those years up until today. So until that dynamic changes, where we begin to produce what we consume, we continually see pressure on the naira, and so we give wrong interpretations to our problem, so to say. In fact, the way I will summarize it is this, that if central bank adjusts the exchange value of the naira today, as most analysts argue, take away the premium between the official exchange rate and the market rate, I guarantee you, in another 3 months to this time, the value of naira at the alternative markets will move again away from the official rate. So until you address what drives that exchange value, you will perennially have to deal with that. I had this question sometime in October 1992 from some set of analysts making this sort of argument. So it's been on for quite a while. And I asked them a question. At that time, the Ghanaian cedi was going for 600, that's the old cedi, for $1. And I asked the question from such analysts, how many of you will feel comfortable to see the Nigerian naira devalue or depreciate to 600 naira to $1 or 1,000 naira to $1? Every one of them was silent. They couldn't answer that question. But here we are today again, how many years after? It's still the same conversation. Until we address the fundamental, and remember, the demand for dollar or any foreign currency at that is not for the sake of the dollar. It is what we call in economic derived demand. So if there's no demand for what you need to buy from offshore, you wouldn't need to look for foreign currency. So that demand is what we need to address. The day we address that, then the conversation about CBN defending the naira, our external reserve is so low, this and that, all of those will disappear from our conversation on economics.
Thank you very much, Dr. Adedipe. Well, we'll wait and see and, of course, hear what the MPC meeting would eventually decide today. That was Dr. Biodu Adedipe, Chief Consultant at B. Adedipe Associates. And that's it on Business Incorporated Special Edition. Thank you very much for watching. I'm Chimezie Obi Iwagu.